This week on WealthTrack, financial thought leader Robert Shiller forecasts the bursting of the tech and housing bubbles. As he tracks the behavior of consumers, home prices, and markets, what does this visionary Yale economist see in our future? We'll find out next on Consuelo Mack WealthTrack. Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. Remember the so-called days of the Great Moderation during the Greenspan years of the 1990s and into the last decade, when policymakers, CEOs, Wall Street pundits, and many investors believed we had tamed the boom and bust economic beast and were forever destined to live in a Goldilocks economy of steady growth, low prices, and near full employment? Did we ever really believe that? We sure did. This week's WealthTrack guest, Yale professor and noted behavioral economist Robert Shiller, wrote about it in a recent New York Times column as, quote, the origins of the current economic crisis, a particular kind of social epidemic, a speculative bubble that generated pervasive optimism and complacency. As Shiller, who predicted both the tech and credit bubbles in several editions of his book Irrational Exuberance, told me, markets are driven by stories and word-of-mouth contagion. Well, the market story is far different today than it was a decade ago. This week alone, we have more evidence of decelerating growth and nervous reaction to it. Revised second quarter GDP turned out to be slower than initially reported and below consensus forecasts. And more recent reports from several regional Federal Reserve banks are showing spreading weakness in business activity. In a much-anticipated speech in Jackson Hole, Wyoming on Friday, where Federal Reserve Chairman Ben Bernanke announced his quantitative easing, or QE2 policy, a year ago, the Fed chief acknowledged the economic deterioration but did not announce any new initiatives to try to stimulate the economy. Longer term, the markets are already reflecting the change in economic narrative. The S&P fell 16% from July 22nd through August 19th, the biggest four-week loss since the market lows of March 2009. And price volatility is still with us on both the upside and the downside. I began our interview by asking Professor Shiller to describe what he calls the malaise that we are experiencing.
Not everyone will agree with this, but I think that there is some sense of hostility at the rich, hostility at our institutions like government. There's a sense of protracted disappointment. We've been in a slow period for 5 years, and there's some impulse to do finger pointing and blame someone. And I think there's some deterioration in our kind of our social compact that's holding us together, which makes it harder to do business, and it becomes to some extent a self-fulfilling prophecy.
Let me ask you about that. I know one of the things that you had told me when I had talked to you a couple of weeks ago was that when the S&P downgrade of U.S. Treasury debt occurred, that you felt that it actually damaged our national pride.
Right. The pride that we have in this nation is very important. And by the way, it is supported by people in other countries. Other countries respect the United States. They may criticize it, they may be angry with it, but they respect it, as shown by the fact that they send their money to be invested here, even at low yields.
You've talked many times on WealthTrack about the importance of human psychology and attitudes, and so the complacency and optimism that we had prior to the financial crisis, for instance. So we're seeing a change in that, and that the cultural zeitgeist has changed. So how significant is that change? And is there anything, I mean, how easy is it to reverse it and to bring at least the optimism in this country back, which is so important to the economy, right?
We do have confidence indexes, which are low, but not super low. I mean, I don't know that they capture all of the nuances that we need to capture. The thing that is really striking is in the housing market, that the interest in home buying has just plummeted. Now, that is partly because it's difficult to get a mortgage. But it's not offsetting that, as mortgage rates are extremely low now by historical standards. So why is it that new home sales are so down, housing starts and permits are so far down that people just are not looking at houses now? I think that it's complicated. There are other factors. For example, the household formation rate is down, so that people are less likely to move out from their parents' house and go buy a house. I don't know that there's any clear explanation of this, but to me it's partly just a loss of our spirit, of our sense that the country is moving forward and I'm going to get out and do something, and it's a little bit weakened now. It's hard to pin this down, but I think it's a factor.
So you've done actually surveys of home buyers or homeowners or potential homeowners, and about what their expectations for home price appreciation are, for instance, and they've changed dramatically from like 5 years ago or 10 years ago.
It's interesting. The median expectation at the peak of the market was something around 7% a year.
In 2005, you mean? In 2006, is that the
and
peak?
now the median is down to 4% a year. So, and it sagged gradually over 5 years. So it's not like people react suddenly to some event, or like Lehman Brothers was an event in September 2008, and there was a sharp crisis then, but the people didn't suddenly change their expectations. It's been sagging for 5 years.
And what's so interesting is I know you and a couple of other economists co-authored an article called Wealth Effects Revisited, and which concluded that the change in housing values continue to exert a larger and more important impact on household consumption, which of course is 70% of our economy, than do changes in stock market values. So this is, I mean, our attitudes towards homes and the value of our homes, right, has a huge impact on the economy.
Right. I think that homes are more immediate and visceral than our stocks. Often stocks are held in a retirement portfolio, and for young people, that's so far away. I mean, they don't even feel like they own it. It used to be in the 1990s, you could borrow against your home equity, and there were competing offers coming in the mail every day to let you do that. Now that is happening less, and people are feeling damaged that I had this wealth. I thought I was a millionaire, or I thought my home would soon be worth $1 million. But now it's going down, and so it changes their willingness to spend. And I think this is a case Quigley and I concluded in our paper, that it was a major, the housing price decline and the reaction of homeowners to the decline is a major part of the whole financial crisis.
So what is the Case-Shiller Home Price Index, telling you about the future of home prices? The results have been weak for a number of years as prices have declined. So what's the outlook for home prices?
Well, my company, Macro Markets, has been doing surveys of professional forecasters, and the consensus is for modest increases for the next 5 years, but just about keeping up with inflation, so that in real terms, no change. My own personal sense is that maybe they're a little bit optimistic. I don't know, but I think home prices could fall further. We're seeing a weakening economic situation now, and they've been falling for the most part for 5 years, and I don't see clear signs that it's on the way up now.
Do we still have farther to go, or are home prices, kind of more historically in line with other indicators? Or
well, real inflation-corrected home prices using the S&P Case-Shiller National Index are down 40% from the peak. That's a major drop in home prices, and it brings us close to the long-run historical trend, but it hasn't overshot yet. And historically, speculative prices, when they're coming off a bubble, often overshoot. So I don't see any reason why they should go down further now. They're back down at a good level, and with low mortgage rates, they look pretty affordable. But they could overshoot because we don't know what's going to happen to the confidence and psychology going forward. What's going to happen to our financial institutions? Our Congress is not contracting our expenditures rather than expanding them, and it's already been 4 years since the beginning of the recession. We're supposedly in recovery, but a weak recovery. It's been a long time, so. There is concern right now for the housing market and for the whole economy.
So how concerned are you about the economy right now?
Well, I think that it's a big unknown where we're going. Economists like to think of themselves as scientists. They are scientists, social scientists. They do statistical analysis of historical periods. The problem is that the recent crisis is a rare event historically. To get a similar crisis, we have to go all the way back to the Great Depression.
And in terms of what? Because I've talked to some other people about that, and they said, in fact, that if you look at what the unemployment rate was during the Great Depression, it's far higher than it is now. If you looked at the...
I know it is higher, but where else do you find something as high as what we have now? There was the 1981-82, what they called it then the Great Recession. Mm-hmm. Now we've now usurped that term for what we are going through recently. The unemployment rate did get up a little higher than it is at our peak in the 21st century, but not long-term unemployment. Long-term unemployment is much higher than it's been. It's looking more deep-seated. Also, the 81-82 recession got over with, and it had a nice, much faster recovery than we're showing now. So it looks like we're in a period of languor, or something isn't picking up from the, and that again sounds like the Great Depression, although I'm not claiming that we're going to be as bad as that, but I'm saying that the phenomenon has parallels that worry people. The problem with the Great Depression is that the economic confidence didn't come back until World War II, and then we had this stimulus package that, it wasn't the stimulus, it was the war that stimulated the economy.
You're famous for your predictions on the tech bubble, the housing bubble, the credit bubble. So are you seeing any extremes in the economy or the markets now, whether it's in this country or overseas?
Oh, any place where it's a bubble right now. Well, certainly overseas. There are bubbles going on in housing in China, last time I heard in Australia, in Brazil. Even Canada has been picking up a little bit, not so dramatic. So it's a complicated world. Not everything is in sync. In the U.S., the place that comes to my mind as a bubbly sector recently is farmland. So farmland prices, at least in the Midwest, have been picking up. And they've increased a lot over the same period that housing prices increased. But they're not done yet, it seems. They may continue to go up.
So let me ask you about the stock market, because your CAPE ratio, the cyclically adjusted price-earnings ratio, which values the market based on 10 years of trailing earnings, versus what everybody else says, which is estimates of future earnings, has been showing the stock market is overvalued, the S&P 500 is overvalued. So, what do we do with that information? Number one, how overvalued does it look, and does that mean we should be selling stocks, or how do I use the CAPE ratio to my advantage as an investor? Well,
the CAPE ratio is, I think, better than the conventional price-earnings ratio. It should be hands down. Don't just look at last year's earnings. Look at a longer average. But people are conservative, and they like to do things the way they've done them in the past. But I think it's actually very basic that you want to compare price to some long average. So if you look at that, the ratio recently has been around 20, which is higher. The historical average is more like 15. So the stock market looks highly priced, but not super highly priced. It got up to 46, the price-earnings ratio, in 2000, just before the drop in stock prices. So that ratio is discouraging to stock investors, but not overwhelmingly discouraging. And if you take into account that the stock market has been a very good investment for 100 years or more, it's not too disquieting. I think that one might make a substantial investment in the stock market now. But with full knowledge. It shouldn't be everything because it is risky.
How discouraged do you get, or how worried or frightened do you get about the kind of volatility we're seeing in the stock markets?
Yeah, I feel upset about it because I think that it's a psychological phenomenon that is kind of a social epidemic that feeds into our other anxieties and animosities, and I don't like the destabilizing influence that it's giving. Mm-hmm. The kind of volatility that we've seen historically, now I can't be statistically accurate about this because these are rare events we're talking about, but this kind of volatility could precede big stock market drops. So for example, the biggest stock market drop in one day in U.S. history was the 1987, October 19th, 1987 drop. But if you look at the preceding that, there were big record drops in the preceding week and in preceding months and going back to the preceding year. We don't remember that at all because it's been superseded by the much bigger one in 87. It gets people talking a little bit on edge, but the market goes up and people think it's over and everything's fine. But back in their mind, there's a bit of anxiety about maybe I should sell. And stories that might encourage people to be a little bit more trigger happy on getting out will then make the market vulnerable. So the thing is, my secretary asked me the other week, should I sell? That's a sign. It's like Bernard Baruch when he heard the shoeshine boy advising him to pick some stocks. It's the same. I hear people who don't normally talk about stocks telling me, should I get out now? Right. That's the kind of framework that could, I'm not saying will, but could lead to instability. It's a sense of where our attention is more focused on the market and we're more thinking, especially with the recent financial news, thinking that this could be it could really drop. And so when people think it could drop, they can make it drop.
So if the shoeshine boy to Bernard Baruch is saying, should give me a stock tip, then he's saying sell. But if somebody's saying,
that's what Baruch said. I'm out of the market. When the shoeshine boy tells me.
Right, out of the market. But if more and more people are talking about, I don't want to be in the market, therefore isn't that the time when we're kind of supposed to at least...
This is why I don't know. You're exactly right. Nobody knows what the market is going to do. I think that there's a vulnerability. This is what we call volatility, because I think it can go either way. But there is a real chance of a substantial drop in stock prices. I'm talking big, especially with the anxieties we have now, with the downgrading of the U.S. debt, with the European debt problems, with weakening GDP numbers both in the U.S. and Europe. And that kind of environment with people remembering the recent volatility, it really sets the stage for... you can see the mood, and you can see that it could change in a bad direction. But it doesn't necessarily have to. It's like predicting an argument with your spouse, right? You seem to be arguing. It's feeding back. It's getting worse and worse. But then suddenly we make up. No, I can't explain it, and suddenly we're happy again. This is the way it is with the economy. This is a social science. It's not a physical science.
A couple more questions. One is, I'm going to ask you for your one investment recommendation. So what is it that all of us should own some of in a long-term diversified portfolio?
Okay. Well, I'm going to be provocative here and offer, as a one investment, the investment that by some accounts looks like the worst of them all. And that is, I've mentioned this before on this show, TIPS, the Treasury Inflation Protected Securities. The safest asset in the world. That's why I want to mention it. It's the safest asset in the world.
So why do you think that U.S. Treasury inflation protected securities are the safest asset in the world with the downgrade?
Yeah, the downgrade doesn't mean anything. The U.S. government will pay its debts. And
thank you, Bob, for saying that.
And they're promising a real payment. In other words, it's going to be corrected for inflation. And that's what you care about, the real value of something. So long-term government bonds could be inflated away if the Fed were to be overly ambitious with its quantitative easing, and they might do that. So it makes bonds risky. Not TIPS. They have no risk. But I was going to add, there is a little bit of a negative and that is that the yield on them recently has been negative, even on 10-year tips, which are relatively long-term. And that sounds bad, right?
Right, and when you said the yield is negative,
that means
you mean
if you hold them for 10 years, you will get back less than you put in.
Even with the inflation adjustment?
That's with it. You'll get more in dollars, assuming there's inflation. But in real terms, you will get back less than you put in.
Because of what the rate is on them now?
It's negative. It's like a negative interest rate. And you might ask, how can it be a negative interest rate? Why would anyone go into something? Because you've got to save. You've got to put your money somewhere. And you cannot find any investment that doesn't have the risk of a negative return. This one, the negative return, actually it's slightly positive yesterday. It bounces around 0. So you might actually get a positive return of 0.05% or something like that. But the reason I'm trying to be a little provocative here, but it's not being provocative, it's the truth. Don't be dissuaded by a negative return. As part of your portfolio, it's a stabilizing thing. It doesn't produce return.
A final question. When you were on WealthTrack before the financial crisis really hit, I remember talking to you about, number one, you were saying that people should lighten up on their home, investments if they had a second home or whatever. But the second thing is that you said that you would talk to your wife, who was a child psychologist, who said, let's get out of the market, the stock market, which happened to be a terrific call on her part, and you did. So what's your advice now? I mean, should we get back in the market? Should we, what's...
Yeah, well, I'm not a financial advisor, but...
I know you're not.
I recommend, actually, if you get this in. I have no connection to financial advisors, but I think people should get one and talk it over. I mean, talk these things over with someone who has some better perspective. You can make mistakes if you're not as familiar with these institutions. But in terms of just a general gut reaction to the stock market, I think that young people should own stocks, particularly because they can handle the risk and it has a lot of return. Older people have to be more careful. As the stock market goes down, I think we should generally rebalance and put more in. It's not just rebalancing. As it goes down, it becomes a better investment. And so that's what's been happening since April when stock prices have been coming down. People should be going in a little bit more. There's a question of downward momentum. You might think, well, it's been going down, it's going to keep going down, so I'll wait a while. There is some evidence for momentum in the stock market, but it's weak. I think the overwhelming thing is rebalancing. So when the market goes down, start moving into it. Not aggressively. This is not a time to be aggressive in moving into it, but moving into the stock market.
Robert Shiller, it's always a pleasure to have you on WealthTrack. Thank you so much for joining us.
My pleasure, too.